There's this moment buried in the 1840s that most people have never heard about, and it's going to completely change how you think about your retirement timeline. I'm talking about something that happened in Britain involving a railway company, a bunch of investors who thought they were geniuses, and a financial mechanism that destroyed entire family fortunes in less than 6 months. Stay with me here, because the pattern that emerged back then is the exact same pattern that's quietly stealing your retirement security right now, and 39 is the age where you either catch it or you don't. My name is David, and I spend way too much time thinking about the hidden mathematics of retirement timing. If you're someone who's been told to just keep contributing to your 401k and everything will magically work out, but you're starting to suspect there's something they're not telling you about when those contributions actually matter most, subscribe and like this video. It will help more than you think. By the end of this video, you'll understand the exact compound interest threshold that financial institutions deliberately obscure, because if you knew when it actually kicks into high gear, you'd realize that most retirement advice is designed to benefit them, not you. I'm going to show you the precise mathematical breaking point that separates people who retire comfortably from people who work until they're 75, and it's not what anyone's telling you. So let me take you back to 1845, to a railway boom that was about to teach Britain a lesson about timing that somehow got completely forgotten. Here's what was happening. Britain in the mid-1840s was obsessed with railways, the same way people got obsessed with dot-com stocks in the late 90s, or crypto in 2021. Parliament was approving railway projects left and right. In 1844, they approved about 50 new railway lines. By 1845, that number jumped to over 200. Everyone wanted in. The investment structure was brilliant. At least it seemed that way. You'd put down a 10% deposit on railway shares, and you wouldn't have to pay the remaining 90% until the railway actually started construction, which could be years away. Now, you might be thinking, that sounds like free leverage. And you'd be right. That's exactly what it was. Investors were buying shares in 10, 20, 30 different railway companies, only putting down 10% on each one. A middle-class clerk making £300 a year could control railway investments worth £3,000 by only investing £300 upfront. The potential returns were enormous. Early railway companies were paying dividends of 8, 10, sometimes 12% annually. Government bonds were paying maybe 3%, so of course everyone piled in. But here's the catch. By 1846, all those railway projects started construction at the same time. Suddenly, investors who'd bought shares in 15 different railway companies got 15 different notices saying, "Pay us the remaining 90% you owe." A guy who'd invested £300 thinking he was diversified now owed £2,700 he didn't have. The smart money, the people who'd promoted these railway schemes, they'd already sold their shares to these middle-class investors at inflated prices. They were out. The clerks and shopkeepers and small business owners were left holding the bag. In October 1845, the railway share bubble peaked. By October 1846, railway share prices had dropped 40%. By 1847, respectable families were selling their homes to cover railway calls they couldn't pay. Banks that had lent money against railway shares started failing. The economic panic spread beyond railways into general commerce. And here's the kicker. The people who promoted these schemes, guys like George Hudson, known as the Railway King, he'd already converted his railway shares into actual assets like land and country estates. He lost his reputation eventually, but he'd already extracted the wealth. The middle-class investors lost everything because they entered at the wrong time and didn't understand the payment structure until it was too late. So what does this have to do with your retirement and why 39 matters? Everything. Just like those railway investors didn't understand that timing and structure mattered more than just getting in, most people don't understand that retirement saving has a critical threshold point where the mathematics completely change. And for most people, that point hits right around age 39. Imagine you're filling a swimming pool with a garden hose. Except this hose has a weird property where the water pressure doubles every 7 years. For the first 7 years, you're filling it at normal pressure. You look at the pool after 7 years and it's maybe 20% full. You think, man, this is gonna take forever. For the next 7 years, the pressure doubles. Now you're at 14 years in and the pool's maybe 45% full. You're making progress, but it still feels slow. But then something wild happens. In year 15 through 21, the pressure doubles again. And suddenly that pool goes from 45% to 75% full. And in the final 7 years, it goes from 75% to completely full and overflowing. That's compound interest. And most people quit filling their pool right before the pressure starts really building. They look at their retirement account at age 35, see it's only at $90,000 after contributing for 10 years, and think this isn't working. They reduce contributions, or they cash out for a house down payment, or they just get discouraged. They stop right before the doubling effect kicks into high gear. Here's the actual math with real numbers. Let's say you start contributing $500 a month to a retirement account at age 25. You're getting a 7% average annual return, which is conservative historically for a stock-heavy portfolio. By age 35, after 10 years and $60,000 in contributions, you've got about $87,000. You've contributed $60,000 and earned about $27,000 in growth. The growth is nice, but it's less than half your contributions. It feels like you're doing most of the work. By age 45, after 20 years and $120,000 in contributions, you've got about $260,000. Now you've contributed $120,000 and earned about $140,000 in growth. For the first time, the market gains have exceeded your personal contributions. This is where it starts feeling real. But here's where it gets really interesting. By age 55, after 30 years and $180,000 in contributions, you've got about $613,000. You've contributed $180,000 and the market has generated $433,000 in gains. The market has done more than twice the work you did. And by age 65, after 40 years and $240,000 in contributions, you've got about $1.3 million. You contributed $240,000 and the market generated over $1 million in growth. The market did more than 4 times the work you did. Now you're asking yourself, okay, so what makes 39 special in all this? Here's what nobody tells you. The critical threshold, the point where compound interest starts doing more work than you do each year, hits for most people between ages 38 and 41, depending on when they started and how much they're contributing. This is the inflection point. Before this age, you're the engine. After this age, the market becomes the engine. Let me show you exactly what I mean with the same example. At age 35, with $87,000 in your account, if you contribute $500 that month and the market grows 7% annually, your account grows by about $1,000 that month. 500 from you, 500 from market growth. You're doing half the work. At age 39, with about $150,000 in your account, your monthly contribution is still $500, but the market growth that month averages about $875. The market is now doing more work than you are. This is the crossover point. By age 45, you contribute $500, but the market adds about $1,500 that month. By age 55, you add $500 and the market adds about $3,600. The ratio keeps expanding, but it only expands if you make it to the crossover point and keep going. This is where the railway parallel comes back. Those British investors in 1845 got in at exactly the wrong time, right before the payment structure crushed them. But the opposite is also true. Timing determines everything. If you stop contributing or pull money out right before your crossover point, you miss the entire exponential phase. You were filling that pool with a trickle hose, and you quit right before the pressure was about to quadruple. Now, you might be thinking, okay, but this assumes I started at 25. What if I started late? What if I'm already 42? Here's the math on that. And it's not comfortable, but you need to hear it. If you start at age 35 instead of 25, contributing the same $500 monthly at 7%, you hit your crossover point around age 48 instead of 39. You've lost 9 years of the exponential phase. By age 65, instead of $1.3 million, you have about $613,000. You lost about $687,000 by starting 10 years late. That's not a moral judgment. That's just mathematics. If you start at 40, your crossover point hits around age 53. By 65, you have about $382,000 instead of $1.3 million. Starting 15 years late cost you over $900,000 in final wealth, even though you only missed 15 years of $500 monthly contributions, which totals $90,000. The compound interest you missed was worth 10 times your actual missed contributions. And this is exactly what the financial services industry doesn't want you to focus on. Because if you really understood this, you'd realize that every single year before your crossover point is exponentially more valuable than every year after it. A dollar contributed at age 28 is worth approximately 8 times more at retirement than a dollar contributed at age 58, assuming the same investment returns. But nobody talks about it this way because it's inconvenient. Think about how retirement advice is actually marketed to you. You see commercials with people in their 50s and 60s on beaches, playing golf, finally relaxing. The message is always about the destination, never about the critical timing windows. Why? Because the financial industry makes more money from your fees over time. They want you contributing steadily forever. They don't want you to understand that there's a specific age range where your behavior matters 5 times more than it does later. Here's another angle nobody discusses. Your earnings typically peak between ages 45 and 55. That's when most people get their highest salaries. So the conventional advice is to really ramp up retirement contributions during your peak earning years. Max out that 401k when you're making the most money. Sounds logical, right? But mathematically, it's backwards. A $500 contribution at age 30 when you're making $60,000 a year has vastly more impact than a $1,000 contribution at age 50 when you're making $120,000 a year because of where each contribution sits in the compound interest timeline. Let me show you this with actual numbers. Contribute $500 at age 30, let it grow at 7% for 35 years until you're 65. That $500 becomes $3,833. Contribute $1,000 at age 50, let it grow for 15 years until 65. That $1,000 becomes $2,759. You contributed twice as much in the second scenario, but it's worth 28% less at retirement because you contributed it 20 years later. The conventional advice tells you to contribute more when you earn more. The math tells you to contribute more when you're younger, even if it hurts, even if it means living in a cheaper apartment or driving an older car. But again, the industry doesn't emphasize this because they'd rather you contribute consistently at whatever level for as long as possible. They optimize for their fee collection, not for your wealth accumulation. Now here's a psychological trap that destroys people right around age 39. You hit the crossover point where compound interest starts doing more work than your contributions, but you can't see it yet because the absolute numbers still feel small. You've got $150,000 in your retirement account and you're thinking, I'm 40 years old and I need at least $1 million to retire. Probably more. At this rate, I'll never make it. I should pull this money out and invest in something with higher returns, or use it for a business, or buy real estate. The account feels like it's growing too slowly, so you make a change right at the worst possible moment. This is exactly like selling your railway shares in 1846 because the price dropped 40%. Not understanding that the fundamental asset, the actual railways, were still being built and would eventually be worth far more. You panic at the inflection point and lock in the loss right before the exponential gain phase. Let me tell you about someone I know who did exactly this. Guy, I'll call him Marcus. because that's not his name. Marcus worked in tech sales, started contributing to his 401k at age 26. By age 40, he had about $200,000 saved. He was contributing around $700 a month between his contribution and employer match. He looked at that $200,000 and calculated that even if it doubled every 10 years, he'd only have $400,000 by 50 and maybe $800,000 by 60. He convinced himself that wasn't enough, and he was right. It probably wasn't. But his solution was to stop contributing to his 401k and instead put that $700 monthly into a self-directed trading account where he could be more aggressive. Over the next 10 years, from age 40 to 50, Marcus contributed that $700 monthly into his trading account. He wasn't reckless. He bought individual stocks, he researched some ETFs, tried a few option strategies. His average annual return was about 9%, which is actually pretty good. Better than the 7% his old 401k was probably averaging. By age 50, his trading account had about $143,000. Not bad, right? He beat the market average. But here's what happened to the 401k. He abandoned at age 40 with $200,000 in it. He left it there, didn't touch it, didn't add to it. It just sat there, growing at about 7% annually in a basic target date fund. By age 50, that abandoned account had grown to about $393,000. He didn't add a single dollar for 10 years, and it nearly doubled purely from compound growth. Meanwhile, he contributed $700 every single month for 10 years into his trading account, $84,000 total, and ended up with $143,000. If he just kept contributing that $700 monthly to his 401k from age 40 to 50, he'd have had about $768,000 by age 50. Instead, he had $393,000 in the abandoned 401k plus $143,000 in the trading account, totaling about $536,000. He cost himself about $232,000 by switching strategies right at his crossover point. And remember, he actually beat the market with his trading. If he'd matched the market or underperformed, which most individual investors do, the gap would have been even worse. This is the psychological trap. Right when compound interest is about to take over as the primary growth engine, the account still feels too small. You lose faith in the process. You think you need to do something different, something more active, something that feels like you're more in control. And that decision, made between ages 38 and 42, is what separates comfortable retirement from working until you're 70. Now let's talk about who actually benefits from you not understanding this timing mechanism. The financial industry is set up to obscure the crossover point because acknowledging it would require them to give different advice to different age groups, and that's complicated and doesn't scale. It's much easier to say everyone should contribute 10 to 15% of their income consistently throughout their career. That's simple, it's universal, and it keeps money flowing into accounts they manage. But think about the incentive structure. Financial advisors and fund managers earn fees based on assets under management. The longer they keep your money invested and the more you contribute, the more they earn. If they told 35-year-olds that the next 7 years of contributions matter more than the following 20 years combined, what would happen? People would front-load their contributions aggressively from 35 to 42, then potentially reduce contributions or move money into different vehicles afterward. That's less predictable for the industry. They want steady, consistent, long-term contributions because it creates steady, consistent, long-term fee revenue. Here's a specific example of how they obscure this. Retirement calculators. You've used them. You plug in your current age, current savings, expected retirement age, and how much you're contributing monthly. The calculator spits out a projection of what you'll have at retirement. But notice what these calculators never show you. They never show you the year-by-year breakdown of how much came from your contributions versus how much came from compound growth. They never highlight the crossover point. They just show you a smooth curve going up and a final number. Why? Because if they showed you that at age 39, your $500 monthly contribution generates $500 in monthly growth, but by age 45, that same $500 contribution generates $1,500 in monthly growth, you'd immediately realize that increasing your contribution from $500 to $700 monthly between ages 35 and 45 is worth exponentially more than increasing it from $700 to $1,000 between ages 50 and 60. You'd prioritize completely differently. You might live more frugally in your 30s and early 40s, then relax a bit in your 50s once you've hit critical mass. But that's not the behavior they want to encourage. The industry also benefits from employer matching structures. Your employer offers to match your 401k contributions up to, say, 6% of your salary. That sounds great. Free money, right? And it is free money. You should absolutely take it. But notice the framing. It's a percentage of your current salary. If you make $70,000 at age 30, 6% is $4,200 annually. If you make $110,000 at age 45, 6% is $6,600 annually. The match increases as your salary increases, which means you're getting more free money later in your career. But as we've already established, that $4,200 contributed at age 30 is worth far more at retirement than $6,600 contributed at age 45. The employer match structure subtly encourages you to increase contributions as you age and earn more, which is exactly backwards from the mathematical optimum. Now, I'm not saying don't take the match at age 45. Of course, take it. I'm saying the structure is designed around what's administratively simple for employers, not around what's mathematically optimal for your compound interest timeline. Another way this gets obscured is through target date funds. These are the funds that automatically adjust from aggressive to conservative as you approach retirement. If you're retiring in 2060, you buy the 2060 target date fund, and it starts out heavily weighted towards stocks, then gradually shifts toward bonds as 2060 approaches. The marketing says this protects you from a market crash right before retirement, which is true. But what they don't emphasize is that this shift typically starts around age 50. From age 50 to 65, your fund is gradually moving from maybe 90% stocks to maybe 50% stocks and 50% bonds. Bonds historically return about 3 to 4% annually, compared to stocks at 7 to 10%. So right when you've hit the exponential phase of compound growth, right when your account balance is finally big enough that market returns are adding massive amounts each year, the fund automatically reduces your exposure to those higher returns. You spent your 20s and 30s building the balance with high stock exposure, accepting volatility, and just when that balance is large enough to generate serious wealth from stock market returns, you're shifted into lower return bonds. Again, there's a logic to this: volatility protection. But the effect is that your compound interest curve, which should be going exponential from age 50 to 65, gets artificially flattened. The fund structure prioritizes capital preservation over growth exactly when growth would benefit you most. And this happens automatically, without you actively choosing it unless you understand what's happening and opt into a different fund structure. Now let's get into what you actually do about this. If you're younger than 39, you're in the window. Every dollar you contribute right now is worth multiples of what it'll be worth if you contribute it later. This is not the time to buy a new car. This is not the time to upgrade your apartment to impress anyone. I'm talking about real sacrifices that feel disproportionate to your current income. If you're making $70,000 a year at age 32, contributing 15% feels massive. That's $10,500 annually, almost $900 a month. It means living on $59,500 instead of $70,000. That's a different lifestyle. Smaller apartment, older car, fewer vacations, less dining out. But here's the math. Contribute $10,500 annually from age 32 to 42. That's $105,000 over 10 years. Let it grow at 7% until age 65. That's another 23 years of compound growth. That $105,000 contributed in your 30s becomes about $547,000 by retirement. That's a 5x return on money you contributed before age 42. Now compare that to waiting. Say you don't contribute that $10,500 annually from 32 to 42. Instead, you contribute it from age 50 to 60. Same 10 years, same total contributions of $105,000. But now it only grows for 5 years until retirement at age 65. That $105,000 becomes about $147,000. Same contributions, same number of years contributing, but you end up with $400,000 less because you contributed it later in the timeline. If you're already past 39, the math changes, but the principle doesn't. You need to contribute more aggressively than someone younger because you've already lost years on the front end of the exponential curve. If you're 45 with only $100,000 saved, you can't contribute $500 monthly and expect to hit 1 million by 65. The math doesn't work. You'd end up with about 600,000, which might be enough depending on your expenses, but it's not the million you're targeting. To hit 1 million by 65, starting at age 45 with 100,000 already saved, you need to contribute about $1,250 monthly at 7% returns. That's $15,000 annually. If you're making $100,000, that's 15% of your gross income. It's painful, but it's the mathematical reality of starting later. You have to compensate for lost time with higher contributions because you no longer have time on your side. Here's another action point nobody talks about. If you're in your 30s or early 40s and you get a raise, don't inflate your lifestyle. Root the entire raise into retirement contributions. You were living on your previous salary just fine. If you get a $5,000 annual raise, increase your retirement contribution by $5,000 annually. You won't feel any lifestyle reduction because you never had that money in your spending budget. But that $5,000 increase, invested over 25 years at 7%, becomes about $27,000 at retirement. Get 3 of those raises between age 35 and 45. That's $81,000 in additional retirement wealth you created without feeling any lifestyle sacrifice. The psychological trick here is to never let your spending rise to meet your income. This is incredibly hard because everyone around you is doing the opposite. Your coworkers get raises and buy new cars. You get a raise and route it into a retirement account nobody sees. You feel like you're falling behind socially. You're driving a 10-year-old Honda while your colleague who makes the same salary just bought a new BMW. But in 20 years, you'll have an extra $300,000 in your retirement account, and that BMW will be worth $8,000. Now, let's address the objection you're definitely thinking. What if the market crashes right after I contribute all this money in my 30s? What if I dump 15% of my income into my 401k from age 35 to 45, and then the market crashes 50% when I'm 46? Didn't I just lose everything? No, and here's why. If you're contributing monthly, your dollar cost averaging automatically. You buy more shares when prices are low, fewer shares when prices are high. A market crash in your 40s, before you retire, is actually good for you because you're still contributing. You're buying shares at discount prices. When the market recovers, which it historically always has given enough time, those discounted shares you bought during the crash are now worth substantially more. Let me give you real numbers from the 2008 financial crisis. Say you were 40 years old in 2008 with $200,000 in your 401k, contributing $1,000 monthly. From October 2007 to March 2009, the S&P 500 dropped about 57%. Your $200,000 account dropped to about $86,000. You lost $114,000 on paper. That's devastating emotionally. But you kept contributing that $1,000 monthly through the crash. From November 2007 to March 2009, you contributed about $17,000 while the market was tanking. You were buying shares at 50% off. By March 2013, just 4 years after the bottom, the market had fully recovered to pre-crash levels. Your account, which had dropped to $86,000, was now worth about $290,000, even accounting for the crash. Why? Because you kept contributing during the crash and bought shares cheap, plus your original holdings recovered, plus you contributed another $48,000 over those 4 years. If you'd panicked and stopped contributing in 2008, your $86,000 would have recovered to about $200,000 by 2013, just getting back to even. But you would have missed out on the $90,000 in additional growth from continuing to contribute through the crash. The crash hurt, but continuing to contribute during it accelerated your wealth building. This is why the crossover point around age 39 is so critical. If a major crash happens in your early 40s, you still have 20 plus years until retirement for recovery and continued growth. If a major crash happens at age 63, 2 years before retirement, you're in trouble because you don't have time to recover and you're about to start withdrawing money. This is the actual risk, not crashes in your 40s. Here's something else that matters around this age: lifestyle lock-in. By your early 40s, most people have established a lifestyle that's hard to downgrade. You've got a certain size house or apartment, a certain type of car, certain vacation expectations, certain social activities that cost money. If you didn't prioritize retirement contributions before this lifestyle locked in, it becomes psychologically much harder to reduce spending later to increase contributions. But if you prioritize contributions in your late 20s and 30s before your lifestyle fully inflates, you never miss the money. You build your lifestyle around your post-contribution income. If you're netting $4,000 monthly after retirement contributions, you find an apartment for $1,200, a car payment for $300, and you build your life around the remaining $2,500. It never feels like sacrifice because you never had the alternative. This is why people who start contributing early often find it easier than people who start late, even though early contributors have less income. A 27-year-old making $55,000 who contributes 15% is living on $46,750. A 42-year-old making $95,000 who suddenly tries to start contributing 15% has to figure out how to live on $80,750 when they've been living on $95,000 for years. The lifestyle downgrade feels like punishment. The 27-year-old never experienced the higher lifestyle, so there's nothing to miss. Let me hit you with one more angle on the 39 crossover point. It's not just about compound interest on your retirement account. It's about the compound effect of financial decisions in general. Your 30s are typically when you make the biggest financial decisions of your life. Do you buy a house or keep renting? Do you buy a new car or a used car? Do you have kids and how many? Do you take on debt for a graduate degree? Each of these decisions has compounding effects over decades. Buy a house at age 33 with a 30-year mortgage. You own it outright at age 63, right when you might want to downsize or retire. That's perfect timing. Buy a house at age 45 with a 30-year mortgage. You own it at age 75. You're either still paying a mortgage in retirement or you're forced to sell before you planned. Finance a $35,000 new car at age 31. You might still be driving it at age 41 when it's paid off and worth $12,000. You got 10 years of use and still have equity. Finance a $35,000 new car at age 48. You're paying it off at age 54 and it's worth $9,000. And you're closer to retirement when you might need that cash for other things. These timing decisions compound just like investment returns. Getting the sequencing right in your 30s sets up decades of beneficial compounding. Getting it wrong means you're fighting uphill in your 40s and 50s. Here's the brutal truth nobody wants to say out loud. If you hit age 45 with less than $150,000 in retirement savings, you're almost certainly going to work into your 70s, unless you're willing to make dramatic lifestyle changes. The math just doesn't support traditional retirement. To go from $150,000 at age 45 to $1.5 million at age 67, you'd need to contribute about $1,800 monthly at 7% returns. If you're making $100,000 annually, that's about 22% of your gross income going to retirement. After taxes and that retirement contribution, you're living on maybe $55,000. That's doable, but it requires a level of discipline most people don't have. especially if they've been living on 80,000 post-tax for the previous decade. This isn't about shaming anyone. It's about mathematical reality. The compounding curve is exponential, which means the back end is massive, but only if you build the front end properly. If you don't build the base in your 30s and early 40s, the exponential growth in your 50s and 60s has nothing to compound from. You're trying to grow a tree from a seedling when you needed to plant it 20 years ago. So why does all this center on age 39 specifically? Because for someone who started contributing in their mid-20s, 39 is roughly where the inflection point hits. It's where market returns equal or exceed personal contributions on a monthly basis. It's where the psychological battle is hardest because the account still feels too small, but the math is about to shift dramatically in your favor. It's where people most commonly give up or make changes right before the exponential phase begins. And it's roughly the midpoint of your career, the moment where you transition from building the foundation to harvesting the growth. If you're watching this and you're 34, you have about 5 years to build the foundation before the exponential phase. Every month matters exponentially. If you're 46, you're past the natural crossover point, which means you need to force it by contributing more aggressively to make up for lost time. And if you're 53, you're in the exponential phase, but with less time, which means you need to maximize contributions and avoid any withdrawals or panic moves because you're finally in the phase where the money grows itself. You just need to not interfere with it. The action step is different for each group, but the principle is the same. Understand where you are on the compound interest curve. Understand what behavior that position requires and execute that behavior even when it feels disproportionate to your current situation. That's what